We also have to talk about what I call the budget hangover. Remember that frantic rush at the end of 2025? Chains forming overnight, offers flying in, solicitors swamped. That wasn't confidence. That was deadline psychology. People were scrambling to beat potential stamp duty changes, pulling demand forward from 2026 into the final months of last year. Now fast forward to February 2026 and the sugar rush has worn off. That artificial surge has faded and what we're left with is the real market underneath. Right now, we're seeing a huge amount of stock sitting on the market, in some regions at the highest levels in a decade. And basic economics kicks in. When supply rises sharply while buyer demand is held back by higher interest rates, prices don't crash overnight, they soften, listings take longer to sell, and reductions become more common. This is where the headlines start shouting collapse, but this is also where context matters most. Here's the key reason a total crash remains unlikely: the housing shortage. The UK still isn't building enough homes, not even close. New supply continues to lag population growth, household formation, and long-term demand. And that imbalance creates something incredibly important in the market: a price floor. Unlike 2008, we're not dealing with mass over-leveraging, loose lending, or forced selling on a national scale. Most homeowners today are on fixed rates, stress-tested at higher levels, and sitting on significant equity. That means fewer people are forced to sell into a falling market, which is exactly what turned a slowdown into a crash back then. So while we may see 5 to 10% corrections in certain overheated pockets, the idea of prices falling 20 or 30% across the board runs straight into a structural wall. Too many people, not enough homes. In other words, this isn't a market collapsing under its own weight. It's a market digesting excess slowly and unevenly, while a chronic housing shortage quietly props it up from below.